Today, we will talk about commercial paper, an unsecured, short-term debt instrument commonly used by corporations. Commercial paper is a form of unsecured, short-term debt commonly used by companies to finance their payrolls, payables, inventories, and other short-term liabilities. It is typically issued by corporations at a discount from face value, reflecting prevailing market interest rates. The maturities on commercial paper range from 1 to 270 days, with an average of around 30 days. It's important to note that commercial paper is issued in a minimum denomination of $100,000 and pays a fixed rate of interest that fluctuates with the market. Commercial paper was first introduced over 150 years ago when New York merchants began to sell their short-term obligations to dealers to access capital needed to cover near-term obligations. It is important to understand that commercial paper is not backed by any form of collateral, making it unsecured debt. It differs from asset-backed commercial paper, a class of debt instrument backed by assets selected by the issuer. In either case, commercial paper is only issued by firms with high ratings from credit rating agencies. These firms can easily find buyers without having to offer a substantial discount for the debt issue. Promissory notes, or simply notes, are debt instruments written by one party to another that promise to pay a specific amount of money by a certain date. Notes are a common way for companies to issue commercial paper. A draft is a written agreement between three parties: a bank, a payer, the drawee, and a payee. The bank instructs the commercial paper issuer to pay the lender, payee, a specific amount of money at a specific time. The issuer of commercial paper is the entity that is creating the short-term debt to fund their short-term cash needs. Most issuers are large corporations with strong credit, as the issuer may demonstrate a high probability of being able to pay back debt, especially in the short term. The maturity of commercial paper designates how long the debt is outstanding for the issuer. Commercial paper often has a term up to 270 days, though companies often issue commercial paper with a maturity of 30 days. At the end of the maturity period, the commercial paper is technically due, and the issuer is now liable to return investor capital. Commercial paper is often unsecured, which means there is no collateral for the debt the issuing company is taking on. The idea is because commercial paper's maturity is so short and the credit worthiness of issuers is higher, the debt does not need backing by corporate assets. Commercial paper is issued at face value, meaning a debt instrument has a value to it, often in denominations of $100,000. Instead of paying interest, commercial paper is often issued at a discount, or a price that is less than face value. When the commercial paper reaches maturity, the investor will receive the face value amount of the instrument even though they paid a lower discount amount. Commercial paper is often tied to liquidity, the measurement of how well a company's short-term cash flows will be able to cover its short-term debt. Therefore, issuers often create commercial paper to increase their liquidity. On the other hand, buyers of commercial paper may not need cash right away, so they are willing to buy and hold the instrument to increase their cash on hand in the future. A major benefit of commercial paper is that it does not need to be registered with the Securities and Exchange Commission as long as it matures in no more than 9 months, or 270 days. This makes it a cost-effective and a simple means of financing. Although maturities can go as long as 270 days before coming under the purview of the SEC, maturities for commercial paper average about 30 days. Commercial paper is also easier to deal with compared to the effort, time, and money involved in getting a business loan. It offers issuers the advantage of lower interest rates while it offers investors a low risk of default. Finally, commercial paper provides an effective way for investors to diversify portfolios. Companies must have extremely good credit to issue commercial paper. So, it doesn't offer access to capital for all institutions. The proceeds from this type of financing can only be used on current assets or inventories and are not allowed to be used on fixed assets without SEC involvement. Additionally, low interest rates for issuers mean low rates of return for investors. Due to the large minimum denomination of $100,000, commercial paper typically isn't directly available to smaller investors. However, they can invest indirectly through companies that buy commercial paper. Here are 5 key takeaways. 1. Commercial paper is a form of unsecured, short-term debt. 2. It's commonly issued by companies to finance their payrolls, payables, inventories, and other short-term liabilities. 3. Maturities on commercial paper range from 1 to 270 days, with an average of around 30 days. 4. Commercial paper is issued at a discount and matures at its face value. 5. The minimum denomination of commercial paper is $100,000 and it pays a fixed rate of interest that fluctuates with the market. Hope this would help. Thanks for watching.